Liquidity is money and your stop loss is money. Anytime price hit your stop loss, you lose money, and that is liquidity being taken. So as a trader, your gateway from losing money into becoming a profitable trader is you understanding what liquidity is all about. So if you have to escape being a victim of liquidity sweep and inducement, you will eventually become a profitable trader. In this lesson, I'll be showing you exactly how you can identify liquidity sweep and inducement. Then in the subsequent video, I'll be sharing with you how exactly you can be able to trade in this zone. Earlier said, liquidity is money and stop loss is money. So, what then and how do we identify liquidity sweep? Price will always move in the direction of liquidity sweep. In this scenario, price moves this way, it came down and then pushed to the upside. And if you look at this carefully, the next thing we saw was that price pulled back to this downside. And after this downside, price moved up. Now this is an uptrend. In this typical uptrend, we are expecting price to give us a higher low. This is a higher high, a higher low, and then to create a new higher high. But what do we see? Price went to this zone. Instead of going to create a new higher high, price begin to range. So this range that you are seeing here is what we call a consolidation. And this consolidation is a liquidity buildup. It is an inducement. So anytime you see price ranging, that is an inducement. It is a liquidity that is being built in that particular zone. So that simply means that in any price scenario that you realize that price is ranging this way, you should know that there are liquidity that are in this zone. Having said that, we have basically two types of liquidity. We have internal liquidity. We have internal liquidity and we have external liquidity. Now the question is, what is internal liquidity and how do we identify external liquidity? Now, talking about internal liquidity, when we talk about internal liquidity, we have basically two types of internal liquidity. We have a static internal liquidity and then we have a dynamic internal liquidity. So let's begin. What is a static internal liquidity and how do we identify it? For instance, in this movement, price make a higher high, higher low, higher high. Then price came down and price begins to range. Now, this range is happening in a structural zone. Now, this is a structure. This range is happening inside an uptrend. And because this range, if you look at this range, is making a series of what? Equal high and equal low. You can see this equal high, equal high, equal high. You can see equal low, equal low. So because this range is making a series of an equal high and equal low, it is referred to as internal static liquidity. Internal static liquidity. It is internal because this range is happening. This is a higher low. This is a higher high. And this range is happening inside of this movement, not outside of it. So this is what we refer to as internal static liquidity. Now, what is an external static liquidity. I'll show you what an internal static liquidity look like. For instance, in this scenario, so we've talked about internal static liquidity. Now let's talk about internal dynamic liquidity. Now looking at this zone, look at what happened. Price is in a downtrend. This is our higher low, right? And this is our lower high now. This is a downtrend. This is our lower high, and this is our lower low. But in this particular price movement, this lower high and this lower low, you now realize that price begins to do what? Price was building up into this zone. So the movement of this price, you see price ranging. This is not a break of structure because price has not break this structural point. So it's inside of this range, but you realize that there is this movement of something making a higher high, higher low in form of a channel. So all of this movement that you are seeing here is what we refer to as what? Internal dynamic liquidity. It is internal because it's happening inside of this range. And it is dynamic because it is not static. So you can see the level changing to the upside. So this is a typical example of internal dynamic liquidity. So now let's go back to look at exactly what a static liquidity look like. So I've talked about internal static liquidity and internal dynamic liquidity. I remember we say we have two types of liquidity. We have an internal liquidity and then external liquidity. So now, what is external liquidity? In terms of external too as well, we have two types of external liquidity. We have external static liquidity and external dynamic liquidity. For instance, in this zone, in this price movement, we are having what? Higher low, higher high, higher low, and higher high. Now, this particular type of liquidity, this high here was taken for price to push to the upside. So this high that was taken is an external liquidity. It is external because it is outside of the structure. It is not built inside the range. So this is an external dynamic liquidity. This is not static. Then we have this here. So this is what we refer to as what? External dynamic liquidity. This is not a static external liquidity. But there are scenarios where you have something like this. You have price here, then you have price here. And then price will be moving this way. Price will go up, it will come down. To go up, it will come down. In this scenario, this is external static liquidity because this is a complete range, and this range, this market ranging is not like this one. This one happened in a range, but this is happening outside of a range. In this place, this is a consolidation. So in this consolidation, what you will have is an external liquidity, right, that is static. But in this case of trend giving us a higher high and a higher low, what you will have here is an external liquidity, but it's a dynamic form of liquidity because you realize that price is doing what? Price is moving from, this is an external, it will come down now, then push to the upside. So price will keep on taking this liquidity here, but it's not taking this particular liquidity. In a downtrend, this is an external static liquidity. But when you come to an internal dynamic liquidity, look at this now. In this movement, you see price moving this way. So this is a typical internal liquidity. So you see that price will make a movement and play in between and then push to the upside. So let's go to the main chart to see exactly how we can identify this liquidity. Now looking at this scenario, this is AUDJPY. Let's look at this uptrend movement. Price is giving us higher high, higher low, higher high, higher low, and a higher high. So you realize that price take away this liquidity. This liquidity was taken and price pushed to the upside. What do we mean? When price was here, for price to come down, it means there's a selling trade here. But what happened? Price went push above and close, take away the people that sold here in order to move higher. So this is what? This is a liquidity sweep. So this liquidity that was sitting here was taken out. So when this liquidity was taken out, price returned again. Remember when price got here, there were people that bought to the upside. But eventually, price came all the way down here, take away these people that bought here to give us this break of structure. So what happened? Here now there is a liquidity. People were being taken out here. Price pushed to the upside. Now price returned from there and still take the people that were buying out of this trade. So there is a liquidity that was taken here. So now if you look at this, you realize that this is an uptrend, higher high, higher low, higher high. So in this scenario, we have this liquidity sitting here. Price take away this liquidity so that price can push to the upside. So this liquidity that was taken from this zone is a dynamic liquidity, but this is an external because this particular liquidity was not found inside of the trade. And since this liquidity is not found inside the trade, we will now regard this liquidity as an external liquidity because this is outside and it is an external. But this particular liquidity that was taken here is an internal liquidity. Now this is beyond mere words. You need to master. Look at this now. In this scenario, look at this. Price move from here. This is a 4-hour time frame. There is that movement of price from this zone. You can see that this is a low. This is another low. Because price went up, came down again and went up. So looking at this, we are having more or less like a double bottom here. So this double bottom you are seeing here, this is a liquidity sitting here. And price, this is our movement of price. So now there is a liquidity that is sitting in this double bottom. Now because this liquidity is inside of this movement and it has equal bottom, it is being regarded as what? As a static liquidity. But this is what? This is an internal static liquidity. So price liquidity will always attract price. So what happened? Price went and then pulled down towards the direction of this liquidity and take away this liquidity, and that is what resulted into this break of structure. And this external liquidity here was taken, that is the push up that lead to this high being taken. Then again, you can see price pulled down, price went this way, price came this way, begins to give us a lower low, a lower high, a lower low. So price will always move in the direction of liquidity. And again, let me show you something. In this scenario, look at what happens here. Price came, went this way, came down like this, and price went up here. What was the next thing that happened? Price closed above this high. Do you see that? Now there is a liquidity that was sitting here. So price take away this liquidity. You can see that push to the upside. Price take away this liquidity and then continue to give us a new lower low. So now why did price take away this liquidity? This liquidity was taken in order for price to mitigate this other block. Because there is an inducement here. This pin bar take away a liquidity of this high, price return, and because there is an order here, price still need to return into that zone, which we will be discuss that in the subsequent lesson. And look at this, you can see this wick and this wick. This is a liquidity sitting here. This is a liquidity and this is a liquidity. So price does what? Price came down to take away this particular liquidity. So this is how exactly you can identify inducement. This is deep beyond what I just explained. So in the subsequent video, I will tell you how then you can avoid liquidity to sweep in order for you to have your perfect trade entry. Thank you for watching, and if you are yet to subscribe to the channel, please do well to hit the subscribe button and turn on your notification bell so you'll be the first to get notified when we upload our next video. Thank you, and see you in the subsequent video.